So we are recording this meeting. So let me put the PowerPoint. Carol, please tell me if you can see the PowerPoint.
I can.
All right, all right. So let's go ahead and start this thing. Okay, we're going to start with the candlesticks. Okay, so candlesticks are exactly what you're seeing here on this rectangle upside down. This is a candlestick. So every little rectangle here is a candlestick. So why candlestick is so important? Because candlesticks representing they are going to represent the opening and closing price at a specific time frame, right? So we are looking at this candlestick. So this is a daily time frame. So that means that today the price opened at, for example, for SPY 366.92. It closed at 368.48. And these weeks you're seeing here on the candle, they are price moves. So eventually during the day, the price went up to 371. Okay. This is Nasdaq. I'm sorry, I was saying SPY, but this is Nasdaq. But and when it went back down, it closed at 368. So, and there are many ways to see price action. So if we can go back to not price action, candlesticks. If we go back to SPY, this is the same thing I was telling on the YouTube video. It opened right at 334. It went all the way up to 337, but it found the resistance here, exactly what I said on the video yesterday. As this price level was rejected, and it came back down to 334. So
what do you mean? Sorry if I can interrupt. So what do you mean the price was rejected?
So that means when the price reached this level, and this was a gap level, the bears saw a chance to sell on the market and attack the bulls. And there was actually some volatility today on the economic calendar. There was an FOMC meeting today, and there was something else that I can't remember now, but I mentioned in the previous video. So the bulls could not hold the price until this point. So it went back down. So this level rejected the price and went back down. So the bears kind of, won the battle for the day, if you can say so. But the bulls are still on the advantage. If we look here, at the 15-minute time frame, okay, this is the history for today. You see, so the session started today on this candlestick. Okay, actually, this was the candlestick that the session started today. So 15 minutes later, opening and closing price. Again, 15 minutes later, opening and closing, opening and closing, opening and closing. You see how this goes? You see, you see the opening and closing of the prices at every 15 minutes. So you see that eventually we reached the level at noon today. That was the highest level. But the bears, looking at this, they started to attack, and they started to short the market. So as the bears started to short the market, the bulls could not hold this level. So the price started to come back down again. But this is fair play, okay? This is actually a healthy bullish structure. So the stock market actually never goes up on the straight level, right? So the stock market never goes up on the straight level. Although this was since you see, we are looking at the 15-minute time frame. So from 6 October, there's kind of a very, very bullish trend line here, but stocks never really go at a straight level. The structure of the stock market is always something like this. Oh, sorry. So this is actually a upward structure. This is actually it doesn't want to release me. Okay, so this is actually a bullish structure. So it never goes up on a straight line. So let's go back to the presentation now. So on this basic training, we see only the Japanese candlesticks. That's what I'm showing you. There are several kinds of candlesticks, but we're going to focus on the basic training on the Japanese candlesticks. So the basics, right? As I mentioned, when this is a bullish day or a bullish time, the stock market. This is the opening price. This is the close. This is the highest of the day, and this is the lowest of the day. These wicks are also called shadows. So shadows represent the lowest price it went on the day and the upper price. Same goes to a bearish candle. So this is going to be the open. This is going to be the closing, lower shadow, upper shadow. The maximum price of the day or the time frame you're looking at, the lowest price. All right. So there is there are a few candles we're going to be looking at. The big candles represent something major going on, right? There are several kinds of candles. So the big red candle is a bearish sign, and of course the green candle is a bullish sign. So there are other kinds of candles to be talked about. We have the doji candles. That is this format that there were a lot of doubts. The market doesn't know if it wants to go up and goes down, and it's a sign of a neutral pattern. You know, the long-legged candle is actually a great doubt here, and it may not be just a single line. There can be some thicker line here too. We have the gravestone. That means this is a bearish sign, and we have the dragonfly, which is going to mean a bullish sign. And as I mentioned on the video yesterday, I'm going to show you an example of this. So the dollar index, right? So let me go back to, so the dollar index was actually a doji candle. So there was some, there are some questions here. Eventually the price opened here, but close, so close to the opening, right? And there was some big move up and down. This is the market not really knowing exactly what's going to happen. So this is actually a neutral pattern. Same thing happened to the TNX. So this is a variation of the dragonfly. This is named a hammer, but it's also a dragonfly. Because the top is closer to the upper wick than it is to the lower wick. So this is a hammer. This may represent a what is the name? A bullish momentum. But we always should see on the opening of the next on the next opening day. So let's see where we are at again. Okay. So yeah, those are a variation of the shooting star and the hammer that I just showed you, and actually have a few others like the bearish Harami. When there was a big candle, right, followed by a red candle, it may signify the end of a trend from bullish to bearish. And we have also, for example, when the market's going down, right? So when the market going down, we saw that on the S&P 500. What happened? Let me represent this on a different way, right? We had a lot of red candles here. And this was a bearish Harami. This could represent the end of the trend. But that didn't happen. But then again, we had a doji here, and we had a bearish Harami. That represented the beginning of a new trend. That actually acted as a reversal here. That's only one of the signs. Okay, so let me go back here to the candlesticks. So we have also this pattern named engulfing bullish. I'm sorry. That means when we have this big when we have this big green candle engulfing the red candle, that also may represent the end of a pattern, I mean, the end of a trend and the beginning of a new trend, this is a very, very good bullish sign. Same thing, the engulfing bearish. When you have this big red candle in front of the green candle. All right. We good? Any questions? No? No question?
No.
All right. So next slide. Some important concept also, supply and demand. This is a very, very popular theme. Supply and demand is exactly what happens when the price, well, demand, right? The prices are very, very low, and people are gonna feel, hey, this is cheap. I think I better buy this thing because this product is so cheap now. Let's say that this is something popular, right? Like Pokemon cards or maybe Tamagotchi. So, and the price changes along the day or along the weeks, and people think like, oh, Tamagotchi or the Pokemon cards are really, really cheap right now. I gotta buy them because people may want to buy them back in the future, and I can sell for a profit. So that happens, and people get excited, and they start to buy the Pokemon cards, and the prices change. You know, the opening and closing price changes, and then they vary a little bit. Maybe maybe a few people that bought the Pokemon cards here, for example, they decided to make a profit here. You know, and other people also, you know, I'm realizing my profit. Oh, it's getting cheap again. I'm buying this thing back. So I'm buying back, you know, it's approaching the supply zone. Hey, I'm seeing there is a supply zone over here on this price, you know, and people are going to stop buying, so I'm going to sell because this thing may go down, and I may lose the chance to, I may waste the chance to sell this thing. So the people sell until it gets kind of cheap, closer to the demand zone. Is that clear what I'm saying here? When the price is attractive, people buy it. When it starts to get expensive based on the history or based on this resistance level, people start to sell because prices start to get expensive. And this is a temporary thing. Like, for example, in the market, right? If we go back to the SPYs, look, this is exactly the example that I use. There was a temporary time range that we saw this thing happening. So during this time, right? So let me go put a vertical line here until, let's say, oh, hold on a second. This line, the supply and demand zones were quite clear. All of a sudden, the supply and demand zones. Oh, I don't know what happened here. The supply and demand zones started to change, and all of a sudden, okay, this is actually a bullish sign that we may or may not talk later. When the price actually started to break the resistance or the supply zone, it just so happened that created what? This actually created a new. Oh, let me try to move this thing here. Create a new demand zone here. And you see, when the price was rejected at this level, it became a new supply zone. Is that clear? Please confirm it's clear, guys. Carol, you good? All right. So, and we're going to talk about trend lines in a bit too. But remember when I said the market was oversold? So the price of the Pokemon was coming down. It's coming down, it's coming down, coming down, coming down, coming down. It reached exactly the trend line. So it was so close to the demand, it's time to buy. The Pokemon was really, really cheap here. And I'm talking about the S&P 500 actually, right? So this actually became a new support level, and this became a new resistance level. And I have supply and demand levels. I have many supply and demand levels, and I keep talking on the videos. And they should represent either support or resistance for the prices. So that was a supply zone. That was a temporary supply zone, as I mentioned to you here, where the price was rejected. That was a temporary supply zone. But we still have you see what I mean here? We have a dynamic supply and demand zone. And we have to keep, we have to be very, very attentive to the supply and demand zones. So there are three types of trends, right? There is the upper trend, there is the sideways trend, and there is the downtrend. Uptrend, right? This is a very, very good example of an uptrend. Here, the uptrend was broken, but from this date, we are looking again at the daily time frame. From the May 3rd until 15th of August, we had an uptrend. We also had here a temporary range, right? So it was actually a trading range, and also known as sideways trend. Things may not always be perfect. Okay. So this is kind of a sideways trend. You know, there was a lot of indecision here. The market didn't know what to do. So the trend was going sideways, up and down, up and down, up and down, until the trend was broken. And what happened? A new uptrend. When the uptrend was broken, a downtrend. Downtrend was broken, a new uptrend. So let me take away this so we can visualize this thing better. Right? Same thing here. Same thing here. And this is, keep in mind, these trends can be medium-term trends. So this was a short-lived downward trend, right? So we had, again, a new uptrend here until it was broken, and we had a new downtrend. Well, look at this. Actually, look at this real quick. As investors, we have to think long-term. We have to see what's going on here at a long term, okay? Let me remove all this mess from here. On the weekly time frame, I'm going to remove this thing from here. We had a clear uptrend. So on the week started on December 19th of 2022, okay, until now. This is a clear uptrend. So when people say, oh, they started to cry recession, it doesn't make any sense. They try to sell fear when the market has a bullish structure. It doesn't make any sense. And the proof here is on the chart. So even the recession, Carol and Sharon, one could argue that we may never really enter a recession because, you know, from March 2020, okay, and I'm going to draw something named Fibonacci here. From March 2020 until January 3rd, look how the stock market, look at this upper trend. It's nothing short of extraordinary, right? When we had a retracement, maybe I'm going to say retracement instead of a downtrend, the lowest price point reached the 0.5 on the Fibonacci level. And there are two ways to look into this. You can draw the Fibonacci like that, or you can draw the Fibonacci like that on in between the upper and the lower points. And look at this, the 0.618. Okay, this is the golden level of the Fibonacci. The candlesticks were dancing around the golden level. For many people on the market, this was never a recession. but it was actually a retracement otherwise from a very, very big move that happened in the stock market. You know what? Another way to look into this very quick. If you go to the moving average, we're going to see a little bit of moving average. It is a common theme. You know, many people agree on the technical analysis that the 200-day moving average. Actually, I'm sorry, I made this thing wrong. Moving average. Simple. Yeah, I'm gonna change this thing real quick. I'm gonna put the 200. Okay, and the style, I'm gonna make it more visible. Is an understanding on the stock market that if the price action is above the 200-day moving average, is actually on an uptrend. Many people don't even trade or short the market when the candles are above the 200-day moving average. So look at what happened here. From March 2020 until October 3rd, 2022, do you see how this touched the moving average, the 200-day moving average? And this move was rejected by the moving average and continued going back up. So this is an important this is an important I'm sorry, this is a important dynamic demand. It was a dynamic support because the moving average, you know, the moving average is a calculation in this case of the 200 last candles, and as I said, represent a bullish momentum on the candles that are above the 200-day moving average. So do you see how the moving average came to the rescue eventually? And the price just kissed the moving average, but it was rejected and went back up again. So when I keep saying that the market structure is good, let's go back to the daily time frame. We had a demand zone here, and it was touching the 200-day moving average. So that was a fantastic dynamic demand zone for us, and we pounced and the risk reward ratio was so good, is very, very hard to pass. Okay, so let's go back to the presentation. So as I mentioned, the trend lines, right? This is an example of trend line break. I just showed here on the SPY. Channels represent a vision of what's going on an equity when this is going up. You see here, for example, on this Mama stock, it started the price action. I mean, the trend line actually forms here a support for the price. So the price, the price hardly goes under the trend lines. And here on the channel, when you see on this line that's upwards, the price action, it represents a resistance. So you see how the price is not crossing here the resistance?
I have a question.
Okay, go ahead.
What could make the price go above the channel? What could make the price of the stock go above the channel?
So that's a good question. This is going to be usually a lot outlier. This may represent the end of the channel, actually. So when you have the price going up the channel, like for example here, we saw this again with SPY, right? So there was actually here a trend line. I'm going to draw this trend line real quick. Okay, I think this is fair. This is a trend line that's touching the lowest points here on the price action. Okay, and if I go and okay, let me see if I can drag this into. Let me just do this. I'm going to clone. And this is going to be a channel, right? On the simplest terms. So the channel You see how this is touching the upper price here on the channel. So the candles don't go anywhere. They don't cross the upper channel. They don't cross the upper level, I should say, almost any time, right? They are respecting this upper level until this point. This was an outlier, but what happened here? The price went back real quickly the next day. I mean, it was actually one day above the channel, and the next day it closes under the channel, and then went back to normal, and then started to go back up. And the prices started to cross the channel again on the upside, right? And this is the behavior like, okay, there is something going on here. This may signify actually that the channel is started to break or a reversal. And we saw a reversal here on the price action. All right, is that clear?
Yeah, thank you.
You're welcome. So the same thing with channel down, same concept, an upward line and a downward line. Head and shoulders is actually a bearish pattern that may represent also, as I said, a reversal on the market. And actually, you saw that with S&P 500. Let us clean this thing real quick here. So red and shoulders are not that clear and requires a trained eye to be able to see it, actually. But do you see how this represents kind of the left shoulder, the head, and the right shoulder? And there is a concept here that's named the neckline. This is where the shoulder starts and where the shoulder ends. And the neckline is kind of this line over here. So on this day, okay, 20th September 20, right? There was, do you see in the engulfing candle, Carol and Lucas? The engulfing candle engulfed the previous candle. So the market was kind of neutral on September 19. There was a doji here. But when the next day the engulfing candle showed up and then totally engulfed this, that was a sign, along with big volume, the market was about to reverse. So here was the reverse of the uptrend. We started to go on a downtrend, and we followed the downtrend for a few days. You see how the demand zones were broken, also known as support zone. The support zones were broken until until a outward trend line, until an outward trend line help out this thing, because the candle started to touch this longer term trend line. I should say that this is a longer term trend line. So it started to touch this thing, and as we touch, and the next day was kind of this was a bullish harami, not really an engulfing candle. That was the end of the retracement on the price. Is that clear? Is that good? Okay, let's go back to the presentation, and we're about to finish. We have also the inverted head and shoulders. I don't have an example right now of inverted head and shoulders, but if you guys are curious about patterns and chart patterns, there is a free website named Fanvis, okay, and you can screen for patterns. So, for example, there are many patterns we're not gonna touch here, but if you go to the inverted head and shoulders, and you just put on the charts, there are many examples here of current stocks that are presenting exactly this pattern. RGEN, right, is having this is the head, left shoulder, and the right shoulder. Actually, nothing happened here, but you see with this EMQQQ, I'm sorry, it may start to happen. So let's go back to trading view. And trading view, EMQQ. Okay. So this is actually the inverted head and shoulders. Whenever you see this pattern, you see this time it worked, right? This and the neckline, this actually crossed the neckline here. Let me try to draw this neckline. It's gonna be kind of this. And when the price action, you see the big gap that happened here? The next day it crossed the neckline. It tested, it went too far, then retraced back, but continued going up. And this was like a great trend after the inverted head and shoulder. See, I'm going to draw kind of this. Was a breakup trend until the trend was broken. And then we had a downtrend again. But this is an example that the inverted head and shoulder really worked. So we're about to wrap this thing up. I'm going to just quickly touch on the moving averages, right? So stocks don't always move in a straight line. So the moving average, they kind of smooth the trend. So we have a better grasp of what's going on without making harsh decisions. So this is an example of a 20-day moving average on a daily time frame, right? And the moving average actually is calculated, the simple moving average actually is calculated. For example, if we have a 10-day moving average, you use the 10 closing prices of the last 10 days. So first day 20, 24, and so on. So the average is going to be the sum, 245, divided by 10. The average is 2450. And when that 11th day, this thing gets reset, okay? So simple moving average crossovers. This is a very interesting topic. I'm going to touch on this real quick. So let's go back to another. Let's go back to the SPX here. So this is a very interesting pattern, right? I told you guys that any price above the 200-day moving average means upwards momentum, means a bullish momentum, right? But if I let me copy this thing real quick. Copy and paste. So I'm going to change the length here to 50. I'm going to change the color to gold here. And many times it happens for long-term investors. They look into this crossover between the 50-day moving average and the 200-day moving average. Many times there are big changes on the market when this happens. Many long-term investors, they decide to buy here on the crossover. And they sell, I'm going to give you a different example, right? SPX. We had a death cross here. So when the 50 moving average crossed under to the 200-day moving average, we call that a death cross. People sold here, right? And many people that are investing on long term, they bought back here. So this concept is so powerful. It's so simple and so powerful. Look, I'm not saying this happens every time, but the trained investors, they're going to look into this as opportunities. And there are other things that need to confirm, because many times we have fake signals. But the longer time frame we look at this, the most trustable is this signal. Look at this, Carol. Look at this, Lucas. On the weekly time frame, if you're investing, if a long term, okay, let me admit Corey here. Hey, Corey, I'm so sorry, I didn't see you. We are recording this presentation, so hopefully we're going to be able to review it again. Okay, so guys, look at this. If you're a long-term investor, right, you saw that on the past 50 weeks of price action, cross above the last 200 weeks of price action. And you're an investor here in 2011. And you're a long-term investor, right? Do you remember what I said about maybe we never had a recession, was only a simple retracement? If you bought here on 2011 at the time of the crossing, and I'm gonna try to do this real quick. If you went long here at the time of the crossing on 2011, and you decided to ride this thing until this day, I'm sorry, I didn't hear you. From 2011 until now, you had a 228% profit. And this is not a low number by any means. This is the S&P 500 only. And this is in one of the most trusted and conservative sources of investment, okay? I'm going to give you another extreme example. Let's say now you invested on Tesla at this point, right? You see how the 50-week moving average, hold on a second. Do you see how, Corey, I just muted you because there is some sounding coming from your microphone. You know, I can unmute you anytime. So do you see here what happened to Tesla when the 50-day moving average, and I'm going to have to adjust this chart here, right? Went above the 200-day moving average. And people were still riding Tesla here, okay? If you went long at this time, and if you're still holding Tesla, and this is an extreme situation, you had a 656% profit from this time to this time. Apple, same thing. So if even if your daily, if you look at the daily time frame, okay. So the Apple crossed on the daily on the March 23rd. So keep in mind, when everybody is telling you that we are in a recession, if you bought Apple here, right, and you're still holding Apple, only holding, this is the simplest patterns, you had a 17% profit during a time of recession. Does that make sense, guys? So this is the simplest moving average that we can look at. And I want to end this presentation here because I don't want to overwhelm you guys too much. My advice to you is that try to explore this. You really don't need to open an account on Finviz, on TradingView if you don't want, even though you can open a free account. But you know, if you're more comfortable with the Yahoo website, you can do actually the same thing on Yahoo, and you can have this free account. I just really like TradingView for all this power, for all the power and the tools that provide you. And
Do you know if Yahoo has paper trading as well?
No, it doesn't. Yahoo doesn't have a paper trading, but other broker platforms like E-Trade, like TD Ameritrade, like Schwab, they all provide paper trading. So we can open accounts there. Some of the brokers will require you to deposit, I don't know, maybe 50 or $100, but you're going to be able to use paper trading there. So any more questions, guys? Carol, Lucas. I'm going to unmute Corey here real quick. I don't know if Sharon is unmuted. Okay. If Sharon has a question, Corey has a question. Carol, are we good?
I have a question. So can you please explain
explain what are resistance levels?
Sure, of course, I can do that. So resistance levels, let me take the, let me find this graph here. An example of resistance level. Okay, I just found it. Is not difficult to find. So here during this time frame, this was a resistance level, a temporary resistance level, or a supply zone. You see that during, oh, I'm sorry, I had to move my, I had to move. So let me move my laptop again. So during this time here, and it started on this the 13th of December 2021, right? We started to notice a multiple top pattern here. So the price action really tried to cross this resistance and was rejected until went down, and went back up, rejected, went back down. So what happened? So do you remember what is this concept here? This is a demand zone, also known as support. So the price was actually finding a temporary support here. You see, the support started here. You see, the support, it was actually a resistance before. It became it became a support, a demand zone. So the price tried to go up and found resistance here, went back down, resistance, went back down, almost on the demand zone, back up, back down. And this is not going to be exact. This is not going to be a resistance line. This is more like a resistance region or a demand region. So I hope this makes sense. So this was a temporary thing. And look at this, Carol. Look how interesting this thing is. On December 2021, right? It was a resistance zone. If you fast forward until June 14, 2023, the resistance zone actually became a support zone. And a new resistance zone was formed here. Does that make sense? The price was never able to cross 197 zone here. It happened to multiple days until this is named multiple top, until the price capitulated and went back down again. And look what happened. The demand zone was here, and the price started to dance around the demand zone. Tried to go up, but then went back down again. So what can we expect here, right? If you're investing on Apple, it's better to wait for the prices to cross the demand zone and keep an eye. Let's say you invested on Apple now. You're confident, so the price is going to be moving like that. That's the bullish structure, right? But when the prices reach this point may reject the price again. And what may happen in the future is that this will keep dancing around the resistance again. And eventually it may break the resistance. But this is a level we need to keep an eye on, because this new resistance may represent a problem in the future for Apple, right? Keep in mind, this demand was resistance before, and this demand zone here was a resistance before. Things keep changing, right? This concept is dynamic. So you remember how this used to be a resistance zone? This is the new one. Does that make sense?
Yeah.
Any more questions, guys?
Can you please explain or remember when is usually when people would stop trading. You said that when the market gets to a certain mark, most investors would stop trading.
Okay, that is exactly the resistance zone. You know, let's go back to the Pokemon cards example again. So so the Pokemon cards was really cheap here because that was the new demand zone. There is an evolution on the market of Pokemon cards. So there was a new demand zone here. And people saw, okay, this is a new demand zone. I'm going to start buying my Pokemon cards here. And then at this point, this resistance was not here. Let me go and take away these rectangles from here. Okay. They found out at this level, somehow people rejected this price for any reason. And the price went down. And then people found, okay, this is kind of cheap. I'm going to buy again. And what happened at this level? Hey, the price wasn't able to cross this region. So this may actually be a resistance region. So people now know that this resistance region is hard to break. And some people are going to play that. When they see that this resistance is hard to break, whenever the price goes back to this region again, what are they going to do? They are going to short the market. So when you short the market, you're actually taking a loan on the equity, right? You have a loan on the equity and you ask for a loan. And many people ask for a loan because they are finding interesting also to short the market. And when the market goes back to the demand level, right here, you see how it started to dance around the demand level over here? What they do, they buy to close the long. They buy to close the short. So here, they did it again, demand zone. People started to buy the Pokemon cards until the resistance zone. And here, they are going to, okay, this is going to get close to the resistance zone again. I think I better sell before I take a loss, because people are going to start to short my Pokemon cards again, and I'm going to lose money. So people are going to start realizing the profit before it reaches the resistance. Is that clear? You know, when the prices go back down, they're going to buy again. Keep in mind, this is dynamic. This actually move. This actually changed. Okay, I'm sorry, I did it wrong. Okay, you see again when there was a retracement. This was the new demand zone, right? When the price reaches this point, went up, went down, went up, went down. People started to notice, okay, this is something interesting. The price don't go any lower than this, so this should be the new demand zone. And now, how significant this is. If you go back to the past, this new demand zone was actually a resistance in the past. Eventually crossed the resistance, started to dance around the resistance, went up, new resistance, new demands were created. This is a current demand zone. And probably, again, this is going to be the new resistance zone. Is that we don't have much history also to confirm this is a new resistance zone, but when you see multiple candlesticks not being able to cross up the resistance zone, one is going to assume that the price, when it touches again this resistance level, this supply level, it may go down again. And when the price goes up, what's going to happen in the future? Probably This is going to be the new supply zone. And sometime in the future, may actually have a new resistance zone. So this is going to be a new supply zone. Does that make sense, guys? All right. Any more questions? Feel free to ask anything. Corey, Sharon. Okay, Sharon doesn't have any more questions. Thanks for putting that on the chat, Sharon. I appreciate it. Corey, you got any questions? Let me see on the Facebook chat. So nobody put anything on the Facebook chat. Okay.
Hey, Rod, I don't have any questions, but I think it's pretty awesome that you're doing this for everybody.
Oh, thanks, man. I appreciate it. I'm trying, as I told Carol also asked me why I'm doing this. I believe on the concept of paid forward. I don't need anything from you. The only thing I expect you guys do is to do the same. If you're finding any value on what I'm doing here, please just pay it forward. Just give the same benefit to other people. That's all I'm asking. All right, guys, I think this is a wrap. Thank you so much for attending. I'm going to actually upload this video to YouTube so other people have the chance to watch it too. And have a good night. Thank you.
Thank you so much.
Thank you for the awesome lesson.
You're very welcome. Thank you, guys.
Thank you.
Bye-bye.
Bye.